Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope everybody is tickety-boo and you've all had a wonderful week. So this week our focus is purely going to be what's going on with interest rates in the market. I'm sure you are very aware that we had a mini budget. Mortgage rates either spiked or kind of just disappeared for a while, particularly fixed rates. And last week when we spoke, I was waiting for lenders to come back to market. So I'm just going to give you an update this week in terms of what we have seen in regards to the return to market, what that's actually looking like, and then just give you some advice and thoughts about what to do over the coming few weeks if you are in the market for a mortgage at the moment. We're also going to touch on rental calculations as well. This is the affordability calculation that lenders use when determining whether the buy-to-let mortgage that you're applying for is essentially affordable, because that's having a big moment of change as well and not for the positive. So we're going to cover that off also this week. Okay, so before we launch into what's been happening in terms of the lenders and their return to market with fixed rates, I think it's important to give you some context around what's been happening beyond the kind of world of mortgage lenders in terms of the pricing on the money markets. So essentially there are really two types of lenders, or two ways lenders obtain funds in to be able to lend them back out to mortgage borrowers. So some lenders will lend off what we call balance sheet. So if you imagine NatWest have a load of people who are saving money with them, so investing their money with NatWest, and then NatWest can simply re-lend that money back out to mortgage borrowers. We call that lending off of balance sheet. Other lenders don't actually have kind of savings products or investment products in their product set. They're purely just a mortgage lender. And so these guys will go to the money markets and using various kind of structures will borrow their money via this way instead. Now the money markets are lending money and pricing rates on what's called swap rates when we're looking at fixed rates. So swap rates are essentially where the banks are lending each other money, or lending institutions are lending each other money, and they're trying to look into the future and try and predict what they think interest rates are going to do. And this then sets the cost of lending between the banks in terms of fixed rate interest rates. So what we have seen is, and I've covered this off in previous weeks, but for those who are new to this, we've seen swap rates move up really dramatically. So to give you some context, on the 6th of October 2021, a 2-year swap rate on the money market was 0.547%. It's now 5.198%. A 5-year swap rate a year ago today would have been 0.784%. It's now 4.925. So you can see the massive increase in costs of funds on the wholesale money markets, which unfortunately, the lending institutions simply have to pass on to borrowers via the way of new mortgage products, otherwise they're lending at losses. And we don't want banks or lending institutions to be lending at losses, because if they're lending at losses, they cease to lend money and then we have no mortgages, which would be bad for everybody. So with this in mind and keeping this kind of at the forefront of your thoughts, this will really kind of help you to understand the way mortgage pricing is working. Now, for those lenders who aren't reliant on the money markets, the model is slightly different. And these guys tend to be more of your kind of high street institutions that I mentioned NatWest earlier on. So their funding model will be quite different. Now, these guys will often use the money markets as well as their balance sheet. So they will be kind of reliant on these markets, but not as much as some of the non-clearing bank lenders. So keeping this in mind on the rates that I've just kind of read out to you, so 2-year swaps 5.198, 5-year swaps 4.925. So what we've seen in the last week is lots of fixed rates come back to market. Now, not every lender has come back with fixed rates yet, so there is some way to go on this. Some are still kind of sort of get navel gazing, waiting for the dust to settle, and then they're going to come back out. But those lenders who have come back out, where we're looking at now, so personal name borrowing, very, very vanilla deals, no HMOs, no multi-units. So what we call like a really sort of standard transaction. So 2-year fixed rates from 4.2, 5-year fixed rates from 4.3, and variable rates from 3.14%. In the specialist end of the market, so your limited companies, HMOs, multi-units, 2-year fixed rates are now from 5.09, 5 years from 6.24, and variable rates from 3.99%. So, quite toppy. There are some interest rates out there from lenders who, do normally price relatively competitively, starting with 7s. So actually to be able to say that we've got 5-year fixes starting with a 6 actually feels, weirdly quite good at the moment. Now, where does this leave us? So one of the things we're being asked a lot at the moment is now the right time to take a mortgage, or should I wait? And secondly, should I be thinking about 2-year fixed, 5-year fixed, or variables. So in terms of how we see the market moving, it really is, it's very hard to say. I mean, my suspicion is that swap rates have got room to come down from where they are. So pre-mini budget, they were sitting at around 5-year swap rates, were sitting at around 3.6. Post the mini budget, they actually spiked up to over 5%. They're now sitting at sort of like 4.9-ish, moving around there. I do think there's some room for them to come back down. That's not going to happen until the markets are much more confident in terms of the kind of future, our financial future. And this will be kind of the fallout of the when Kwasi Kwarteng essentially comes and talks to, presents his kind of findings or his plan for how we're going to be able to manage things going forwards, how if we've had tax cuts, how we're going to pay for those. So really the kind of detail of the mini budget, the stuff that sat behind the plans that they made. So I think once we get that information and the markets are a bit more kind of on board with what's going on, hopefully they will be, and we may see swap rates start to settle. So it is now the right time to take a fixed rate. So I do think that mortgage rates have room to come down. However, there are other changes afoot in the way of rental calculations, which I will come on to shortly, which may mean that actually, while you, in terms of the actual interest rate, you might be better off waiting for a couple of weeks just to see what happens. It might be for reasons of being able to actually access a mortgage at all, you need to act now. So I'll come on to that in a bit more detail in a moment. Now, the other thing we've been asked is what sort of rate should I go? Now, looking at the way these swap rates are looking, what we're seeing is that 2-year swap rates are higher than 5-year swap rates. So what that tells us is the money markets are expecting interest rates to go up over the next 2 years and then beyond that start to come back down again. So my thought process here is that actually taking a 2-year fixed rate would be a really bad idea, because if you take a 2-year fixed rate, you're going to take a relatively higher interest rate now, then interest rates are going to go up, you're going to come off your deal and be taking a new sort of mortgage rate, another fixed rate, right at the top of the market before things do start to ease back down. So I really don't think 2-year fixed rates are the way to go at the moment. 5-year fixed rates will obviously ameliorate all the kind of bumps in the road, so that's definitely one to consider. You know, as mortgage business, we're big fans of 5-year fixed rates. They give people long-term certainty, ability to budget and plan. Also, you're not paying arrangement fees and other setup costs every couple of years, which can be, you know, cost saving in itself. So we continue with our advice in that regards. Now, the variable rates is the interesting one. So back to what I said earlier on, so personal variable rate mortgages from 3.14, limited company variable rates from 3.99. I mean, it is a gamble, isn't it? We don't know how much interest rates are going to go up by. If our prediction of base rate going up to 6% is, to be true, then that would see an increase of interest rates of around 4%. So actually your variable rates could look incredibly expensive. Now, I think we've got a way to go in terms of lender offerings here. So what's happened is lenders have removed all their products, they've bought stuff back out as quickly as they possibly can, and now they're probably taking stock and really reconsidering the market and trying to think what they can do. And Keystone Property Finance have done something really interesting actually, and this is quite ingenious. So what they have done is they've launched a bunch of variable rates. They don't have any fixed rates available right now. They will be bringing them back to the market imminently. But what they have said is that any borrower who selects one of their variable rates will be able to move over to an equivalent fixed rate product using a switch and fix facility at any time when fixed rates become available. And they're going to be able to do this easily without incurring any early repayment charges or arrangement fees. So essentially you can take a variable rate with Keystone now, which will probably be lower than their fixed rates. You can sit on it, but at any point you kind of want to move on to one of their fixed rates, they're going to do so. They're not going to charge you an early repayment charge. They're not going to charge you another arrangement fee. So is this having your cake and eating it? I mean, it feels like it, doesn't it? Always the devil is in the detail. If they were to release their fixed rates and they were incredibly high, this wouldn't necessarily be the most attractive offering. But actually, Keystone as a lender sits in the specialist end of the market. Their prices are going to be comparable to everybody else. They're all kind of, operating in the same money markets, looking to make the same margins. So just to kind of give you an idea if this is of interest to you, so Keystone's variable rates on standard properties can be limited company or personal from 4.9 and HMOs and multi-units from 5.15, and they can lend on some pretty lumpy things actually in terms of larger HMOs, large multi-units. So that's something to consider, and I think this really gives you a flavour about what we're going to see going forward. So lenders are going to have to be a bit more kind of creative in terms of the offerings they're bringing to market to really kind of just try and make things better for borrowers ultimately. If we have borrowers who are happy, then that's a good outcome for everybody. So I think that's what we're going to see. Now, rental calculations is a biggie, and this is going to become more of a sticking point over the coming weeks and months. So When lenders are underwriting buy-to-let mortgages and looking at affordability, i.e. how is the mortgage going to be serviced, do the numbers stack up in terms of this mortgage being affordable, what they're looking at by and large is the rental income. So what lenders tend to do is if you're taking anything other than a 5 or 10 year fixed rate, the calculation they tend to use is for personal borrowing 145%, assuming an interest rate of 5.5%, and if it's limited company 125% coverage, assuming an interest rate of 5.5%. Now there are variations on this. Some lenders will apply a more generous rental calculation for individual borrowers if they're a basic rate taxpayer. Some lenders could do something a bit more generous if it's a like-for-like remortgage, so you're not capital raising. So there are lots of permutations with some lenders will factor in disposable income, but by and large these are the calculations that lenders work to. Now what they have been able to do is when you're looking at 5-year fixed rates, lenders have been able to do a calculation which would be for personal borrowing 145% coverage, assuming either the rate on which you're fixing at or a notional rate which would be lower than the 5.5%, so say 4%. Limited companies would be 125%, assuming a notional rate of 4% or potentially against pay rate. So pre all of this really kicking off, we were having lenders who were doing rental calculations which were 125 or 145% on an interest rate of 2.99. Now obviously where the pay rates, the fixed rates have moved up, that means that the rental calculation has moved with it. So on 5-year fixed rates now, the kinds of calculations you're looking at are 125 or 145 at sort of 6.5%. So you can see instantly how the goalposts have moved massively. Now more worryingly than this, the Mortgage Works last week announced that they were changing temporarily to protect landlords their rental calculations. They've moved things to, and this is irrespective of his personal or limited company, a 5-year fixed rate rather, 145% coverage for limited companies or 125% coverage for individuals at an interest rate of 8.49%. So what that means is that in kind of layman's terms, for limited companies, you can borrow 113 times your monthly rent, and for personal, 97 times your monthly rental figure. So this is like a really massive problem for a lot of people if lots of the other lenders choose to follow suit, because it simply means that when it comes to borrowing money, mortgages look unaffordable. Now, is everybody going to follow suit? I hope not. I really, really hope not. I feel that actually this is a massively huge knee-jerk reaction by the Mortgage Works. However, when a large lender like the Mortgage Works, now one of the largest buy-to-let lenders in the UK, does something like this, lenders cannot simply ignore it. They're going to be forced to revisit their lending criteria and kind of see whether they agree with the decision, whether actually they're exposed, if they've kind of missed the trick here and they should be doing something similar. So I am slightly concerned that we're going to see a wave of lenders change their rental calculations going forwards, which means that a load of borrowers are simply going to be unable to get the kind of borrowing that they need. Now, this is going to be obviously very limiting in terms of people who are looking to buy property going forwards, because it's going to really, well, essentially you're going to have to put much more money into a deal. It might mean that you don't have the money and therefore you simply cannot buy something. What is more worrying for me is the situation for people who are trying to remortgage, particularly if you're with a lender who doesn't offer product transfers. So essentially you become a mortgage prisoner. Now what's really interesting is that the lenders are clearly very, very aware of this, and there's lots of conversations already going on in the industry about what lenders can do to kind of try and work around this. So I think really from me, the message is this. While you may not be willing to or not keen on the idea of taking a mortgage right now, because you don't like the interest rates, keep in mind there may be this change around the corner, which might mean that actually you simply would not be able to access a mortgage at all. And I'm not trying to scaremonger you into making quick decisions. I'm really just trying to give you a kind of balanced view about what's going on. If you are someone who has a buy-to-let mortgage, you get it quite aggressively and you do one of those more generous rental calculations in the last few years, I do genuinely believe that the buy-to-let lenders are going to kind of find solutions to help borrowers like you, but it's not going to be an overnight fix. This is going to take some time to come around, so we will keep you posted on this, we will keep you updated, but really just to kind of put this on your radar for the time being. And that really is as much as I have to report to you this week. Now, like I say, I am expecting more rates to come to market. I do believe that swap rates will probably ease back down a bit, which might mean that lenders can drop their rates down as well. But actually, for the moment, we just are where we are. As I've mentioned in previous weeks, if you do have concerns, you just want to have a chat to kind of sound out where things are, find out what your options are, even if actually it transpires that right now you're feeling that it's not the time to make a decision, you don't want to act, but you just really wanted to kind of double check your numbers. Do give us a call. We're really happy to have those conversations. You're under no obligation when you call us up to do anything. We have lots of clients who we kind of speak to regularly. Those conversations, get put on pause and then they come back to it a few months later. That's absolutely fine by us. Obviously, ultimately, we want to work with you, but we're only going to want to do that at a time when it really is beneficial for you to do so. 0345 345 6788. Hopefully, next week I'll be back with some more cheerful news. But, the good news is that the lenders have started bringing out rates. So, while we might not like the options, there are a lot more options available than there were this time a week ago. Look after yourselves. Have a great weekend, and I'll see you again same time next week.